Hey, so in this video, I'm going to talk about why most people don't need a financial advisor. Okay, now as soon as somebody gets some money and they start thinking about their financial future, they start thinking about the question, do I need a financial advisor?
Do I need a financial advisor?
Well, this question has come up for me with a number of friends and relatives recently, so I thought there might be some interest in this subject, so I decided to make this video. So I think the first thing to look at is, what is a financial advisor, okay? So a financial advisor is someone who basically advises you on what investments to make, how to plan for the future, how to plan for retirement, and just give you, overall advice in terms of your financial health. Now, in the old days, going back, 25, 30 years, you didn't have as many choices as you have now as to where you could put your money and how you could manage your money. So I would argue that 25, 30 years ago, once you accumulated a reasonable nest egg, it would probably make sense to actually pay somebody to advise you on how to invest that money. However, over the last 20 years, and even going back further than that, there have been enormous financial innovations to help the retail investor. And therefore, I would say, unless you have an enormous amount of wealth, worth $100 million or something like that, my position is you really don't need a financial advisor. Now, who am I? I am a former investment banker, also full-time investor, both in the real estate, commercial real estate, and the stock and bond market. And I have looked at this very carefully, both for myself and for other people. And I've concluded that in today's market, it is very rare that anybody actually needs a financial advisor, and I'm going to tell you why right now. The most common thing I hear from people is, well, I don't have the interest or the expertise to be able to manage my own money. Okay? This, in my opinion, is complete BS. Not only is it not true, but it indicates just a complete lack of basic knowledge of what tools are available to you today in the financial markets. Whereas in the old days, you really only had two choices, okay? Buy individual stocks, which does require a certain amount of expertise and knowledge, or buy mutual funds, which is what was available years ago through, Vanguard, Fidelity, places like that. You could do that, but it was reasonable to think that, well, I don't have the experience to be able to do that. I don't really know what I'm doing, okay? But today, with the advent of index funds, it has become much, much easier, to the point where anybody can do this. Now, what do I mean by index funds? Okay, index funds are funds that have extremely low fees that simply track the indexes. The two most famous ones are the SPY, which is the exchange-traded fund that basically tracks the S&P 500, and the QQQ, which basically tracks the NASDAQ 100. Now, knowing this, the methodology is very simple, and I would argue anybody can do this, okay? Step number one is decide what allocation you want to have to stocks. I would say for younger people, if you're in your 20s, 30s, and even 40s, you want to have the majority of your investment portfolio in stocks, okay? Now, it's very simple, okay? You say to yourself, I don't have the expertise, I don't have the interest, I don't want to buy individual stocks, I'll get my clock cleaned. Okay, I get it. All you have to do, and this is not my recommendation, this is the recommendation of Warren Buffett and Charlie Munger and other extremely smart people. All you have to do is decide, I'm going to put X dollars into the stock market for long-term growth, and put a percentage of it in the S&P 500 exchange-traded fund the SPY, and put the rest of it into the QQQ, which is basically the NASDAQ 100. Okay, once you do that, you will be guaranteed to keep up with the stock market. You will have an exposure to a large extent, the United States economy, and you will grow exactly proportionally to the S&P 500 and the NASDAQ. And you will have your stock allocation. You're guaranteed to keep up with the indexes, and you're not paying any fees, any significant fees, because these exchange-traded funds have extremely low fees. Now, the reason I recommend this is 80% of active money managers don't even keep up with the market averages. Okay? So what does that tell you? That tells you that any financial advisor that you hire to actively manage your portfolio, number one, they're going to be trying to sell you shit. Number two, they're not going to even keep up with the averages statistically. And you're going to be paying them huge fees relative to the amount of money that you have. Fees vary, but you're going to be paying at least 1% on total assets, and you're going to, in most cases, be paying commissions when they try to sell you all their firm's crap, most of which is not going to work out for you. And over time, I would argue that most of them will not even keep up with the markets. Now, another thing I will say about this is that as a small investor, right, as a little guy, you are not going to get access to the better money management people at any firm, okay? I worked at JP Morgan. JP Morgan has one of the most active and successful money management practices in the business. To get access to their top tier money managers, you have to have a minimum. This is the minimum. This is the minimum.
This is the minimum
that any of these guys will take on is $10 million in liquid assets. So what does that tell you? If you're a little guy, if you have even a $1 million portfolio or even a $3 million portfolio, the level of person that's going to be managing that account is going to be below the top tier of money managers. That's not to say that there aren't some good people in that sector that are willing to take on small accounts, but you're not going to get access to the upper level people, and therefore the level of expertise that these people are going to have is going to be lower. Now, the S&P 500 is a cross-section of 500 stocks across the stock market, so that's the way you approximate the return of larger stocks. But the QQQ is the NASDAQ, and I want to just take a second and show you what is in the QQQ, what are their top investments, so you can see what you would be actually investing in. Okay, so here's the QQQ. Let's scroll down here a little bit, and we see what the top 10 holdings are. And as you can see, all they're really investing in are some of the largest technology and growth stocks available in the market. You got Microsoft, you got Apple, Amazon, NVIDIA, which we've talked about on this channel, Meta, which is Facebook, Google, Tesla, etc. Okay, so these are the top 10 holdings in the QQQ. So when you buy the QQQ, this is basically what you're investing in. So you can see it's extremely easy to do, and by owning the QQQ, you'll have access to some of the highest quality growth stocks in the market. And as far as bonds go, I do not recommend bonds for most people. This, of course, is heresy when you look at the classic 60-40 allocation in classic money management. As people get older, they recommend that you get more into bonds. I do not agree with this, and I would substitute any conservative allocation in bonds and go more into cash and put it into short-term treasuries and just basically keep it in cash. The reason is bonds statistically over time underperform stocks. And a person that I used to work with on Wall Street, who was much smarter than anybody else I've ever known, told me that one thing you should never do in your retirement account is invest in bonds. You should always keep it in stocks, and you can decrease the amount of risk and by investing more in blue chip stocks, or in the case of what I just said previously, you can put more into the S&P and less into the QQQ. I personally wouldn't do that. I would keep either equal allocations, or I would, even at an older age, I would keep more in growth. And if you have money that you absolutely need for retirement or something like that, I would keep a healthy amount in cash so that it's available and it's not subject to any potential risk of losing money. All right, well, I hope you enjoyed this. This is just sort of like an initial primer to why you don't need a financial advisor. I would welcome your comments below. You can ask any questions you want. I answer all comments and questions. So give me your questions and comments below. Thank you for watching. If you got value out of this, please subscribe and like. And I'd love to have you on board for this channel. We talk about the financial markets, the stock and bond market. We talk about trends in the market. We talk about Fed policy, with everything geared toward making you a better and richer investor. Thanks for watching, and I'll see you on the next video.